In this video, we will analyze a few examples of how to enter positions using the HTF1, LTF1 combination. First example. The first thing we need to receive is the V1 volume confirmation greater than V2 volume confirmation. Starting with the one-day time frame, we see that over the last 12 candles, the price has been in a bearish order flow, confirming that sellers dominate the market. One of the most important aspects is that each time the price tests a specific price action element or takes liquidity from a fractal high, it receives aggressive selling volume, which forms new zones of interest. Currently, the closest zone of interest that can provide sell volume in the market is a one-day bearish fair value gap, which can be considered as V1. Now, to validate the idea that this zone is ready to push the price further down, we need to receive variable number 2, again in the form of volume confirmation one step lower in our time frame system. On the 4-hour time frame, the price confirms volume through all possible variants. First, it forms a rejection block, which is a primary indicator that selling volume has entered the market. Second, it forms an order block zone. And lastly, the price forms a fair value gap zone. Any of these zones can be considered as V2. Now that all conditions on the HTF are met, we can move on to the LTF, where there are again only 2 variables to complete the entire combination. V3 trigger, greater than V4 entry. We move to the 1-hour chart and see that the closest trigger is a fractal high that forms a 4-hour fair value gap zone. It acts as a liquidity injection in the market, thus it can be considered as variable 3. The last thing we need to receive to meet all the conditions on the LTF side is volume confirmation in the form of an order block or rejection block on a lower step in our time frame system. On the 15-minute chart, the price performs a liquidity raid at the fractal, then confirms the volume in the form of a fair value gap, which can be considered as variable 4, from which we can freely enter a position. But before that, we need to identify variable number 5, which is the trouble area, or what we also call the target for the position. We then go back to the 4-hour time frame where variable 2 is located and determine the nearest fractal low or fair value gap. Finally, let's summarize everything we've received so far. V1 volume confirmation is a one-day fair value gap. V2 volume confirmation is a 4-hour fair value gap, which has become our point of interest. V3 trigger is a 1-hour fractal high. V4 entry is a 15-minute fair value gap, and V5 trouble area is a fractal low on the 4-hour time frame. The position can be opened in accordance with the strategy and a suitable risk-reward ratio for us, for example, 1:2. The 0.5 level of this FVG is suitable for us. Thus, we receive a test and fast delivery to our target. But how can positions with a high risk-reward ratio be taken if we know the global direction of the market? Here, everything depends on the context. First, if we move to the one-day time frame, we see that before the price forms the fair value gap zone, it tested a one-day rejection block from which buying volume entered. Thus, we received an equal low zone, which acts as a magnet for the price. Secondly, we remember the from zone to zone rule, and logically it can be said that from the bearish fair value gap zone on the one-day time frame, the price will most likely reach the equal low zone, also on the one-day time frame. The potential position can look like this. We see that in the process of price delivery, the price forms a bearish momentum that confirms the fact that sellers dominate the market. However, these are still higher risk positions because we never know from which price action element how much buying or selling volume can enter the market. Thus, even the nearest fractal low on the 4-hour time frame can reverse the price direction, causing us to hit a stop loss. Second example. We repeat the same algorithm of actions. First, we need to establish the logical element on the HTF. V1 volume confirmation should be greater than V2 volume confirmation. On the one-day chart, we see that the price has formed a bullish fair value gap, which can be considered as V1. Next, we need to wait for the price to test this area on a lower step in our timeframe system and confirm the volume through one of the available methods. We move to the 4-hour chart and see that the price has formed a volume confirmation in the form of an order block, which can be considered as V2. All conditions on the HTF are met. The next logical element is found on the LTF, where V3 trigger is greater than V4 entry. Inside the 4-hour order block, a 1-hour trigger is formed in the shape of a fair value gap, within which the price can receive buying volume. This is V3. Our task is just to wait for the test and react to what the market forms. We see that on the 15-minute chart, the price reaches and tests the trigger, forming the entry point. We remember that the entry point is the same as volume confirmation, but in the form of an order block or fair value gap. In our case, this is the order block area from which we can freely enter a position. The last thing we need to identify is variable number 5. This will be the nearest trouble area, either a fractal high or a fair value gap. In our case, this is the 4-hour equal high. The position can be opened with a risk-reward ratio of around 2.6, which is quite convenient for us. As mentioned in the previous example, we never know what buying or selling volume can enter from a particular price action element. Thus, we see that after the price performed a liquidity raid on the equal highs, it was then delivered impulsively in the opposite direction. Third example. On the one-day time frame, an order block zone has formed which can be considered as V1. But what distinguishes an order block from traded volume in this type of movement? As we know, an order block needs to rebalance a fair value gap or perform a liquidity raid. In this example, before the price moved up, it rebalanced the fair value gap. This is an example of traded volume where a zone similar to an order block formed, but it did not perform a liquidity raid or rebalance the FVG. Next, we need to get a test of the one-day order block and volume confirmation on the 4-hour chart. As in the first example, the volume was confirmed by all three methods: rejection block, fair value gap, and order block zone. If we look at the 1-hour chart, we see that near the 4-hour fair value gap, a fractal low has formed, which can play the role of a trigger. V1 volume confirmation is the one-day order block, V2 volume confirmation is the 4-hour fair value gap, and V3 trigger is the 1-hour fractal low. What remains is to get the entry point on the 15-minute chart. The price easily performs a raid on the fractal low, and at the same time tests the fair value gap. It then confirms the volume by two methods we need. The first is the fair value gap, and the second is the order block. All the requirements on the HTF and LTF are met, and the combination is formed. Variable 5 is the trouble area. On the 4-hour chart, this is the nearest fractal high where we will set our take profit. The position is opened from the fair value gap zone, with the stop loss placed below the fractal, and we achieve a risk-reward ratio of approximately 2.2. If this video was helpful and brought more clarity in understanding this algorithm, don't forget to like, subscribe to the channel, and leave a comment.